What is going on, everybody? Welcome back to Trading Learning 101. Today's video topic, we're going to talk about ETFs, inverse ETFs, what they are. We're really going to take our time with this video topic, and I'm going to break down what's the definition of ETFs, where to find them, how to track them, and what they do. If you're interested in more ETFs videos, I have a ETFs playlist. I will leave a description to it down in the video description below, or you can go to the Trading Learning 101 YouTube channel, go to the playlist section, and you will find it there. We have a lot to go over and talk about in the world of ETFs, so let's jump into the video, everybody. To help us understand what are ETFs and the definition of ETFs, we're going to use Investopedia. What is an ETF? An exchange-traded fund ETF is a type of security that involves a collection of securities, such as stocks, that often tracks an underlying index. An index like the S&P 500, the NASDAQ, Dow Jones, and it gets even further with oil, gold, gas, natural gas. There are ETFs for pretty much everything. Although they can invest in any number of industry sectors or use various strategies, ETFs are in many ways similar to mutual funds. However, they are listed on exchanges, and ETF shares trade throughout the day just like ordinary stocks. Some well-known example is the SPDR S&P 500 ETF SPY, which tracks the S&P 500 index. ETFs can contain many types of investments, including stocks, commodities, bonds, or a mixture of investment types. An exchange-traded fund is a marketable security, meaning it has associated price that allows it to be easily bought and sold. Some key takeaways. An exchange-traded fund, ETF, is a basket of securities that trade on an exchange just like a stock. ETF share prices fluctuate all day as the ETF is bought and sold. This is different from mutual funds that only trade once a day after the market closes. ETFs can contain all types of investments, including stocks, commodities, bonds. Some offer US only holdings, while others are international. International as in all around the world. ETFs offer low expense ratios and fewer broker commissions than buying the stocks individually. With most brokers, there are now zero commissions with ETFs as I make this video in 2020. Back before 2020, they would charge fees to buy and sell stocks and ETFs. An ETF is called an exchange-traded fund since it started on an exchange just like stocks. The price of an ETF shares will change throughout the day as the shares are bought and sold on the market. Every single year, ETFs are just getting more and more popular. Here's a graph from 2008 all the way to 2018 showing you the cash invested in ETFs, and you could clearly see every year the graph grows. More and more people are investing in ETFs and trading ETFs. An ETF is a type of fund that holds multiple underlying assets rather than only like one stock. Because there are multiple assets within an ETF, they can be a popular choice for diversification. Types of ETFs. There are various types of ETFs available for investors that can be used for income generation, speculation, price increases, and to hedge or partly offset risk in an investor's portfolio. Below are several examples of types of ETFs. Bond ETFs might include government bonds, corporate bonds, and state and local bonds. Industry ETFs track a particular industry such as technology, banking, or the oil and gas sector. Commodity ETFs invest in commodities including crude oil or gold. Currency ETFs invest in foreign currencies such as euro, or Canadian dollar. Inverse ETFs, which we will go over in a second, attempt to earn gains from stock declines by shorting stocks. Shorting is selling a stock, expecting a decline in value, and repurchasing it at a lower price. Investors should be aware that many inverse ETFs are exchange traded notes, ETNs, and not true ETFs. An ETN is a bond but trades like a stock and is backed by an issuer like a bank. Be sure to check with your broker to determine if an ETN is a right fit for your portfolio. Now, just for some examples, we're going to go over some charts and show you some real world examples of ETFs. The first one we're going to talk about is the SPY. The oldest surviving and most widely known ETF tracks the S&P 500. On the right chart right here, SPX, this is the S&P 500. The current price is $2,929. On the left is the ETF SPY, SPY. This is an ETF that tracks the S&P 500, and the price for this is currently at $293. Comparing both charts side by side right here, you could see they're very, very similar. The SPY ETF, which is a leveraged ETF, is going to copy whatever the main index is doing. You're going to see a lot of investors and traders track the SPY, and it's just one of the many S&P 500 ETFs. Another example of an S&P 500 ETF is ticker symbol VOO, and this is the Vanguard S&P 500 ETF, and that is right here on the left. Now we're going to take a look at another example. We're going to look at the Russell 2000, and the Russell 2000 ETF is IWM, which is right here on the left side. This is the 1 minute chart of the Russell 2000 ETF, and the Russell 2000 ETF tracks small cap stocks, and an ETF that moves with the Russell 2000 is ticker symbol TNA, and this is a ×3 leveraged ETF, which means based on the leverage there are ×1, ×2, and ×3 leverages. TNA is a 3 times leveraged ETF that tracks the Russell 2000. So whatever IWM ETF moves, TNA is leveraged to move ×3 of whatever this ETF moves. And you can see both charts are very similar, with this downtrend right here on the left, right here down below the VWAP, and then with the Russell 2000, same thing right here. And then one more quick example, we're going to take a look at QQQ, and the QQQ is the ETF that tracks the NASDAQ 100 index, and this contains technology stock. A website that I like to use when it comes to ETFs and inverse ETFs is Direxeron. Here you will find leveraged ETFs ×1, ×2, ×3. You'll find mutual funds, portfolio ETFs, metric weighted ETFs, and leverage and inverse ETFs. There's multiple lists that go on and on and on about ETFs. We'll dig a little bit more into this website later on in this video, and if you're interested in this website, I'll leave a link down below in the video description if you want to check it out. Alright, now that we've learned what are ETFs, now we're going to learn about what are inverse ETFs. What is an inverse ETF? An inverse ETF is an exchange-traded fund constructed by using various derivatives to profit from a decline in the value of an underlying benchmark. Investing in inverse ETFs is similar to holding various short positions, which involve borrowing securities and selling them with the hope of repurchasing them at lower prices. An inverse ETF is also known as short ETF or bear ETF. Key takeaways: an inverse ETF is an exchange-traded fund constructed by using various derivatives to profit from a decline in the value of an underlying benchmark. So an underlying benchmark is, for an example, we'll go back into the SPY, the S&P 500. Let's say the stock market crash is happening, falling hard. An inverse ETF is going to do opposite of whatever that main index is doing. And there's inverse ETFs for all different sorts of areas in the stock market. Gold, oil, gas, etc. Inverse ETFs are not long-term investments. A lot of inverse ETFs you will see, they naturally decay. Over time, the price just gradually falls and falls and falls. With inverse ETFs, they're just trading vehicles for opportunities that occur in the stock market. For an example, when the stock market's crashing, the S&P 500, the NASDAQ is falling and falling and falling and falling hard and fast. This is when inverse ETFs come in hand. When the markets are falling, you use these inverse ETFs to hedge your portfolio or for day trading opportunities. They'll rocket up in price as the stock market is falling. And as I was saying, inverse ETFs are not long-term investments since they are derivative contracts are bought and sold daily by the fund's manager. As a result, there is no way to guarantee that the inverse ETF will match the long-term performance of the index or stocks it is tracking. The frequent trading often increases fund expenses, and some inverse ETFs can carry expensive ratios of 1% or more. Inverse ETFs versus short selling. An advantage of inverse ETFs is that they do not require the investor to hold margin account, as would be the case for investors looking to enter into short positions. A margin account is one where a broker lends money to an investor to trade. Margin is used with shorting and advanced trading activity. Investors who enter into a short position borrow the securities, they don't own them, so they can sell them to other traders. The goal is to buy the asset back at a lower price and unwind the trade by returning the shares to the margin lender. However, there is the risk that the value of the security rises instead of falling, and the investor has to buy back the securities at a higher price than the original margined sale price. That's with the risk of short selling. And that's why they say with short selling, the risk could be infinite. The prices could keep going up forever. In addition to a margin account, short selling requires a stock loan fee paid to a broker for borrowing the shares necessary to sell short. Stocks with high short interest may result in a difficult finding shares to be short, which drives up the cost of short selling. In many cases, the cost of borrowing shares to short can exceed 3% of the borrowed amount. You can see why inexperienced traders can quickly get in over their heads. Conversely, inverse ETFs often have expense ratios of less than 2% and can be purchased by anyone with a brokerage account. Despite the expense ratios, it is still easier and less costly for an investor to take a position in an inverse ETF than it is to sell stocks short. The pros and the cons of inverse ETFs. The pros. Inverse ETFs allow investors to make money when the market or the underlying index declines. Inverse ETFs can help investors hedge their investment portfolio. There are multiple inverse ETFs for many of the major market indices. Now let's go over the cons. Inverse ETFs can lead to losses quickly if investors bet wrong on the market direction. Inverse ETFs held for more than one day can lead to losses. Higher fees exist with inverse ETFs versus traditional ETFs. Now with this, the higher fees part, depending on your broker, it is currently $2,020. A lot of brokers offer ETFs and inverse ETFs to be traded for free. So check with your broker to see what the fees are on ETFs, inverse ETFs, and equities. Now let's go over the types of inverse ETFs. There are several inverse ETFs that can be used to profit from declines in broad market indexes, such as the Russell 2000, the NASDAQ 100. Also, there are inverse ETFs that focus on specific sectors, such as financials, energy, or consumer staples. Some investors use inverse ETFs to profit from market declines, while others use them to hedge their portfolios against falling prices. For an example, investors who own an ETF that matches the S&P 500 can hedge declines in the S&P by owning an inverse ETF for the S&P 500. However, hedging has risk as well. If the S&P rises, investors would have to sell their inverse ETF since they'll be experiencing losses, offsetting any gains in their original S&P investment. Inverse ETFs are short-term trading instruments that must be timed perfectly for investors to make money. There's a significant risk of losses if investors allocate too much money to inverse ETFs and time their entries and exits poorly. Double and triple inverse ETFs. A leveraged ETF is a fund that uses derivatives and debt to magnify the returns of an underlying index. Typically, an ETF's price rises or falls on a one-to-one basis compared to the indexes it tracks. A leveraged ETF is designed to boost the returns 2-to-1 or 3-to-1 compared to the index. That's why sometimes you'll see, like I've mentioned earlier, the leverage of the ETF or inverse ETF. It'll be either ×1, ×2, or ×3 leveraged ETF. Leveraged inverse ETFs use the same concept as leveraged products and aim to deliver a magnified return when the market is falling. For an example, if the S&P 500 has declined by 2%, a 2 times leveraged inverse ETF will deliver a 4% return to investor, excluding fees and commissions. Now let's go over an example of an inverse ETF compared to an ETF. One of my favorites to watch is the SPY, which is the S&P 500, and the TVIX, TVIX. The TVIX was at one time a ×3 leveraged ETF. They just changed it to a ×2 leveraged ETF. On the left, we have the SPY, and on the right, we have the TVIX. And as you can see, the S&P 500 went up for the day as the TVIX declined for the day. And another key thing that you want to follow if you're following ETFs and inverse ETFs when it comes to the market index is you want to know what the fear gauge is. And I'm talking about the VIX, the volatility index. If you don't know about the volatility index and the fear gauge, I have made a video on this topic already. I will leave a link to that video in the description of this video. Check that video out and check out that inverse ETF or ETFs playlist that I have created. There are many videos in that playlist that will help you out. In the world of ETFs and inverse ETF, it's really huge. There's so much to learn. And the golden rule is don't trade what you do not know. So make sure you do your own due diligence. Learn about all of this before you put up your hard-earned money in trading this type of stuff. Now that we've learned what are ETFs and inverse ETFs, for this last part of the video, let's go through this website, Direxeron, look at some of the ETFs and inverse ETFs, and check them out on charts. What we're going to do is we're going to go to the leveraged and inverse ETFs and click on this. And from here, you can see it gives you a big list that you get to choose from. You got your daily bear ×1 ETFs, daily bull and bear ×2 ETFs, and your daily bull and bear ×3 ETFs. Now for me, I like my ×3 ETFs and inverse ETFs. So let's take a look at those. Once we click on that, then it gives us a big list of all the different types of ETFs and inverse ETFs and what they track and follow. For an example, and we're just going to read what some of these are. We got communication services ETFs, which is MUTE and TAWK. We got the Russell 1000 ETFs, which is FAZ and FAS. Let's take a look at that on two charts. All right, we got FAZ up here on the left, which is a financial bear times 3 ETF, and we got FAS on the right, which is a financial bull times 3 ETF. And you can see right here, it's got this big spike up right here and the big spike down right there, followed by spike back up, spike down, spike up, and it just does the opposite of whatever this does. You could see at the end of the day, this one fell down, this one went up. And an important thing you want to notice if you're going to track ETFs is the volume. Always stick and try to track ETFs that have volume. You don't want to be trading and tracking ETFs that really don't trade much volume. You want to stick to the popular ones that people are following. We'll take a look at another example here. On the left, we got DRIP, and on the right, we got Gush. These are S&P 500 oil and gas exploration and production. You can see with DRIP, it had a morning sell-off. On Gush, rose up. DRIP popped back up, Gush fell down, and then DRIP had a consolidation and then just trended down the rest of the day. With Gush, this consolidation and then just trended up for the rest of the day. And this is just another one example out of this huge list on this Direxion website. These are all the ×2 leveraged and inverse ETFs. Let's go to the ×3. Look at this big list. These are all of the ×3 leveraged and inverse ETFs. We got TZA and TNA, which tracks the Russell 2000. If you want to track the S&P 500, SPXS and SPXL, and do all this stuff on your own too. Pull up two charts side by side like I've been and go through and compare all of these. Track what you want to track. There's all kinds of ETFs and inverse ETFs and on different subjects, whether it be financials, healthcare, home builder supplies, pharmaceuticals, regional banks, semiconductors, biotechs, technology, transportation, aerospace and defense. There's all kinds of ETFs out there, and even your brokers like TD Ameritrade, Charles Schwab, they all offer their own ETFs as well. Again, if you guys want more info on ETFs, be sure to check out the Trading Learning 101 ETF playlist. It's right here. Just go to it, click on it. I now have 6 videos in here all about ETFs. Remember, the more you know, the more advantage you have. So study this topic. Learn more about it. There's a lot to learn, and this is how you develop trading strategies or investment strategies. And if you haven't already, hit that subscribe button, join the Trading Learning 101 community where we all grow as traders and investors. That's going to wrap it up for this video, guys. I hope you had a good time and learned a lot. If you have any questions, leave them in the comments down below. If you enjoyed this video, hit that like button. I appreciate it, and it lets me know that you guys are enjoying the content. And until next time, everybody, have that patience, have that discipline, and study, study, study. Later, everybody.
The most valuable commodity I know of is information. Wouldn't you agree?